It's another edition of the Trading Tips video newsletter, teaching you how to become a successful trader in less than 5 minutes per week. The video newsletter is brought to you by TradingTips.com.
Welcome to this video newsletter on moving averages, simple but effective technical overlays. Let's begin. First, a little about moving averages in general. They are among the most important indicators in technical analysis, second only to volume in terms of technical statistics. There are many kinds of moving averages, but the two most popular and widely used are the simple moving average and the exponential moving average. And finally, moving averages are always calculated for a specific period of time, typically 12, 26, 50, or 200 days. The simple moving average is, well, the simplest moving average. It is calculated by finding the sum of the stock's closing prices for the given period and then dividing by the number of days in the period. That value is then plotted on the stock's chart and connected by a line with the moving average on the previous day, which is connected to the moving average on the day before that, etc. This gives a rolling effect, i.e. if you're using a 50-day moving average, then every day as a new day's price is added in, the oldest day's price is dropped off the end. This gives you a picture of the stock's overall trend, and the moving average also acts a lot like support and resistance. When a stock touches its moving average, it typically bounces off of it, either higher or lower. But if a stock pierces through its moving average, either to the upside or downside, it typically continues in that direction. And of course, the differing time periods tell different stories. A 10-day moving average gives a shorter-term view, while a 50 or 200-day moving average is a much more significant long-term trend line. Here's an example of a stock chart with a simple moving average overlay. It's the red line. You'll notice that from mid-June all the way up till April, the stock routinely pulled back to its moving average. In this case, it's a 50-day moving average, until it finally fell through to the downside. From there, the moving average acted like resistance rather than support, until the stock price broke through again in June of 2000. In October, the stock fell through its moving average line again, which then began to descend and behave like resistance again. Now let's look at exponential moving average, or EMA. The difference between SMA and EMA is that while a simple moving average treats all data equally, the exponential moving average gives extra weight to the later dates. Some traders prefer this, especially in volatile markets, because they say a stock's price 50 days ago, while relevant, is not as much so as its more recent prices, especially if the market as a whole has shifted directions or picked up in terms of volatility. For this reason, EMA is typically preferred for spotting shorter-term trends, and thus 12 and 26 days are among the more popular time frames, whereas 50 and 200 days are the most popular for simple moving averages. Exponential moving averages are altogether less common, and when the term moving average is used, it can be assumed that the source is talking about simple moving average. Of course, the differences between SMA and EMA are very subtle, as this stock chart shows. Here I have the SMA in red with the EMA in green. There isn't a whole lot of difference. Of course, we're using a 50-day moving average here. The difference would be more pronounced if we were using a shorter time frame. Let's look at some other ways to use moving averages. Moving averages play an integral role in the technical statistic known as MACD, Moving Average Convergence Divergence. This was covered in depth in TradingTips.com episode number 1. As we've already discussed, moving averages often act as support and resistance for stock prices. And thirdly, we'll look at what's known as the golden cross. A golden cross is when a stock's 50-day moving average pierces through its 200-day moving average, while both moving averages are trending higher. You can see this happening in late September on this chart. And from there, the stock skyrocketed. This is a chart of Apple, by the way, March 2006 through the first 2 weeks of 2007. You'll also notice that in late 2006, the stock fell through its 50-day moving average and went much lower. And then when it pierced that line to the upside a few weeks later, it rocketed much higher. We hope you've enjoyed this video newsletter on moving averages. Thanks for watching and good trading.
This Trading Tips video newsletter has been brought to you by Manny Bacchus's First Hour Trading System. Every day there's money to be made in the first hour of stock trading. This is the world of day trading, not for novices, unless you have a system. The First Hour Trading System. Visit firsthourtrading.com now and sign up for a free 30-day trial. You could make enough in the first hour of your day to take the rest of the day off. Do you want to view more Trading Tips videos? Visit tradingtips.com. Sign up for our free video newsletters. Become a successful trader by visiting tradingtips.com.